Everybody. We have a special guest today. Peter St. Ange is with us. You may know him by his Twitter handle at Prof. Stange. And Peter, really great to meet you. I'm very interested in your narratives and what you're sharing out there on financial media. So welcome to TradeGATEHub.
Thank you for having me on, Dale. Really appreciate it.
All right, so why don't we start with your background? Uh, I know that you taught MBA students. Were you involved in financial markets back then? What was your introduction to the markets and possibly investing or trading them?
Yeah, back in the 90s, when I was in my 20s, I had money parked over at Schwab, like many of us start out with. And I read an article, it was an interview with Paul Krugman. And he said that the internet was going to have as much impact as the fax machine because we were going to get bored and run out of things to say. And I remember at the time thinking, well, Paul Krugman, I might disagree with him, but I mean, he's got a high IQ. And I figured if Paul Krugman is that stupid, then how many people controlling how many trillions of dollars do not yet understand that the internet is actually a thing? And so I took every dime I had. I was young, so I didn't have kids or anything. I didn't need the money for anything. It was just piling up. And so I put every dollar I had into, let's see, Yahoo at like $60. Everybody told me I was a complete idiot. And then, that just kept splitting. Let's see. SoftBank came into it. Back then, SoftBank shtick was that they were basically cloning all of the American internet companies, and they were doing Japanese versions of it. And so I bought options on SoftBank because that struck me as a really stupidly obvious business plan. That took off. So I retired at 25, went goofed around, spent a long time on like islands in Thailand and whatnot. And I kept sitting there day trading and goofing around with it. And I thought, okay, well, this is not healthy. This is no way to spend my 20s sitting there staring at a screen in Bangkok. And so I thought, okay, I am going to stop looking at it. So I went off to an island, Koh Phangan, to learn Muay Thai, kickboxing. And I figured, okay, that'll keep me away from the computer. And I came in one day for supplies and stopped by an internet cafe. And I thought, let me go see how much money the internet has paid me. And I'll be darned, the thing wiped out. And so, so I was went from like millionaire to like 40,000, which is not enough to retire on, not
When
even in
was that? The
Kopangan.
dot com bust? Is that
Yeah,
when that
yeah,
happened?
yeah. Yep, that
Okay.
was the dot-com wipeout. So I had to go back to the real world. So went to New York, got a job there at a Japanese toy company. I grew up partly in Japan, and so I speak it. And so got a job in marketing at Takara, which made the Transformers. Um, and at that point, part of that process is that you learn a lot about psychology, right? So when you're doing toy marketing, you're marketing to the kids at different ages. You're also marketing to the parents, to the grandparents, to whomever is buying the product. So it's a surprisingly complicated marketing challenge to kind of sketch out profiles, sort of psychological profiles, and to figure out what kind of toy. Okay, you need the kid to ask for the toy, and you need the parent to think that the toy is going to be a useful investment for the kid. And that, my undergrad had been in economics. And of course, economics also is essentially applied psychology. You're trying to figure out, like, why do people do things? So, why do they buy, sell, build stuff, destroy stuff, so on. And what struck me in that was that there are such different models in economics and marketing for how people do things, like why people do things, what motivates them. And what's striking for me is that the models in economics are gorgeous. I mean, they're impressive. They're like whole, 50 pages of calculus, and they're complete garbage, right? And at the same time, in marketing, you also have models, and these things are goofy. I mean, they're just embarrassing. They're like, yeah, if you show it to them 3 times, they'll buy it.
Yeah.
I mean, it's just embarrassing, right? There is no calculus in those things. It's rule of thumbs. And guess what? That crap works. And so that for me was kind of an eye opener. Like I felt like, what is wrong with economics? I think also during my, the 5 years that I backpacked around, I read a lot of books, and coming back to the real world, I kind of missed the intellectual challenge of it. So I decided to go back for economics, but I wanted to study a different type of economics called Austrian economics, which during my travels I had found it and decided that is really the missing piece, where you've
So
got this.
that was your introduction to the Mises Institute,
Bingo, exactly.
and isn't the main theme of what they believe in all comes down to sound money?
Sound money is a huge part of it. I think fundamentally, if I had to like sort of sum it in a single word, it would be that people know what's best for themselves. Okay. They don't need, a government or a central planner or somebody else to tell them. And a big part of that is that translating what you want into what exists in the real world. Okay. So in other words, sort of converting your preferences into reality. Basically half of every single potential transaction is going to be made up of money. And so money ends up having a huge ability to sort of muddy the waters, to create noise in preferences. And then the end result is that, people can end up sort of making a lot of bad choices in life. When you pair that together with just specifically on central banking, that central banking is a way for governments to essentially seize as much of society's wealth as they want, and then they put a certain amount of that seized wealth into attacking you and finding ways to seize even more wealth. So you get this kind of snowball effect with the totalitarians. But anyway, you put those two together, right? The potential for money to kind of screw up economic choices, to make people choose the wrong things in life. You put that together with the totalitarian cancer that central banks feed. And for me, anyway, it's a pretty engaging topic.
Okay. All right. So that gives me a definite understanding about how you feel about the Fed. Uh, it's a Jekyll Island kind of thing.
Yes,
So,
exactly.
right? Okay.
Yeah.
So why don't we talk about, since they have been managing the economy for, I don't know, since 2000 or even before with Greenspan, they called him the
Yep.
maestro.
Always. Yep.
So why don't we talk about where we're at right now? So the market believes, Peter, that we've reached terminal rates,
Mm-hmm.
and it looked like Powell took a victory lap at the last Fed meeting. How are you seeing it right now? And do you believe that just like they were too loose, they've stayed tight too long, and the higher for longer might even exacerbate the impact of what's going to happen economically in the next 6 to 12 months when it filters through?
Yeah, my sort of base case is that they are repeating the error of the 1970s, which is that they spent too much money. So that was the guns and butter of the late 1960s, when they wanted to have all these wars, most prominently the Vietnam War. They wanted to spend all this money on that whilst building out this huge welfare state. That was Lyndon B. Johnson's so-called Great Society that delivered us ghettos across the entire country. So they wanted to spend on guns and butter, spent too much. That led to inflation. And what they did in the 70s is that they hiked rates really fierce, and that caused a big sort of crash in the economy. At one point, they thought at the time that it was about negative 10% annualized growth. That led the Fed to panic. They cut rates too quick. That then gave us a second, even bigger stagflation. And that one, of course, was ended by Volcker. So I think that where we are right now is a very similar place. So during COVID, they spent enormous sums of money, about $6 trillion in deficit spending, in order to essentially bribe the public into accepting these totalitarian lockdowns. And, usually the Fed just steals a little bit. Like, my favorite metaphor is they're a gasoline thief. Okay, so you take like half a gallon from every one of your neighbors so they don't notice. And the trick to that game is you don't take too much at once, right? Like, if you go and drain the whole tank, the gig's up, all right? The guy's going to notice. And this is really the Fed does, right? So the Fed prints on the order of about $1 trillion a year. And normally the people don't get too upset about that because, when all is said and done, it comes out to something like 2% inflation. And people have been brainwashed into thinking that that's like natural, that it comes from the
Normal.
market.
Yeah.
Yeah, and the problem at this point is that during COVID, they printed way too much, because they had pressure from politicians who they wanted to do it either so they could pay their cronies or because the media was accusing them of having blood on their hands if they didn't spend another trillion. Either way, they spent too much. That led the inflation to get out of hand. Now, at that point, the Fed had two choices. It could have done the right thing, which would have been telling the feds to control themselves, quit with the spending, run some
You mean
surpluses for a
like
couple of
Larry
years.
Summers was advising?
Yeah, well, yeah, he wasn't going so far as to go for surpluses, but yeah. So that would have been, kind of the grown-up thing to do. And of course, they didn't do that. Instead, what they did was decided to strangle the private sector, which is pretty much what the Fed always does. You figure that if you got the federal government spending too much, and if you're unwilling to tell them to stop, then you got to get somebody else to quit spending. And somebody else means everybody else than the federal government, so the private sector. So that's what they did, hiking rates. And, the trick at that point is that if you hike too hard, then you get a recession. And so the Fed has to constantly balance the political risks from runaway inflation versus the political risks from being seen as having caused a recession. Now, of course, the Fed causes both. It alone causes both the recession and the inflation, but the problem is, does it think it can get away with it? So my concern at the moment is that the Fed has done absolutely nothing to try to rein in the federal government, and instead it's put it all in the private sector. And I think at this point, the risk is that they're declaring victory too early, right? If we look at a lot of the reasons why inflation has come down recently.
In the
Yeah,
70s, Peter, we tightened, we stopped, we tightened, we stopped,
yep,
and
yep,
then it was Volcker on the third
yeah,
tightening regime.
yeah, yeah,
So could just be round one. We're
yes,
okay.
yep.
Rates ameliorate into the spring, and they have to resume a hiking cycle.
Yeah, I agree. That's my concern. And, I think the biggest fear is that the 70s didn't end because, like Congress woke up and changed its ways, right? The 70s ended because of Paul Volcker, like one single man. And the problem is that from the perspective of Washington, Paul Volcker was a huge mistake, right? He cost his boss his job. So Jimmy Carter lost the election. He cost Democrats. Democrats had an almost 50-year strangle on the Senate. I mean, it was like a one-party state in the Senate. And that finally broke because people were so pissed off at the recession that followed Volcker's hikes. Now, those hikes saved the country, but from Washington's perspective, they were a big mistake. And Washington is not going to take another one for the team. They don't care about the country. They care about the Senate and whether their president's going to win the next election. They're extraordinarily short-sighted, these people. So my concern is that if we get into that hole again, we are not going to automatically get another Volcker. This thing could go on for a long time.
Okay. So you were talking about in your podcast today, I just looked at the topics, that you think that there could be, a debt auction, a treasury auction that could cause a meltdown. Now, last week, there was very poor bid to cover. They said it was a technical issue. And I believe yesterday they had a successful auction. I think
They did.
Santelli gave it a B plus. So
Yeah.
what is it out there that has you worried about an auction that could end up creating a meltdown? Because it does look, even technically, like the bonds, which have had the worst bear market in my lifetime, and I'm not a young guy, so I remember Volcker. So we've never had a bear market like this,
Oh, yeah.
like
Yeah, it's been
we
rough.
had in TLT. I mean, you look at a monthly chart here. We had the lowest interest rates, Peter, since the Civil War, not the one that's going on now. The one where they wore
The other
blue and
one.
gray.
Yeah.
Yeah. So I mean, this is the move. This is the crash, a bond crash. And from 170 to 80, 50% haircut on what was termed safe paper.
Yeah.
Markets bounce, especially when people are convinced that they never will. Do you think that there's a possibility we could have, before there's a meltdown, that the bonds might rally because of perhaps a growth scare that we might have in the US, and actually a bond rally could create it by investors reallocating funds out of equities into bonds.
Yeah. Yeah, I
What
think
do you
without a
think?
doubt, the I think the main thing that's heading that off at the moment is just money markets, right? That rates are so high that any benefit that would normally come to bonds, I think a lot of that is going into money markets. But I mean, fundamentally, yes, you could absolutely have those things. One of the ironies of a crisis is that often on the way to the crisis, the opposite thing happens financially, right? So, for example, the past couple of years, we've been talking about the death of the dollar, and you've got all
Yeah,
these countries getting off the dollar, trying to diversify into gold or into other foreign currencies or physical assets. But the thing is that all that time that we've been talking about all those things, which are true, the dollar has been rallying, right? It's been
there we
having a
are.
fantastic, yeah, there you go. Yeah, you've got the DXY. Now, it just recently turned down, but we saw this also back in 2008 crisis where by all accounts the calls were coming from inside the house in 2008. Okay, that entire crisis was made in America, and yet the dollar rallied during the 2008 crisis because the dollar is a flight to safety. And so bonds
Right.
similarly, the irony of it is that even if our sort of fundamental existential threat here is a sovereign debt crisis, bonds could actually rally going into that because
Right.
relative to, for example, equities, they're seen as a safe haven. So I think I mean, anything, you've been in the game long enough to know that literally anything can happen
And
in
everything.
markets.
And everything. And they do.
Yeah. Oh, yeah.
So,
Without a
so
doubt.
I was thinking that we've completed this first push up and
Right.
that there might be some type of uh, pullback. Maybe that supports a dollar, but um, I've been bullish a dollar a long time, and uh, I've turned bearish long term. So I'm looking at this. I thought we'd get to about 109, Peter, and
Mm-hmm.
we peaked at 107 and a half right here. So it's
Yeah.
my view that what happened back here in 21, this was the top, and this is just a corrective bounce in the dollar, and the dollar could be very vulnerable for something like this to happen from here. Par 99 would be next, but targets mid 90s. So could the Fed make the pain of a recession by weakening the dollar seem more invisible with a weaker dollar, except for prices that would end up pressuring commodity prices higher? But it could keep stocks alive and bonds
Mm-hmm.
alive by debasing here.
They could. I think in the modern Fed, they don't pay a whole lot of attention to the exchange rate relative to the interest rates, just because the transmission is so much more roundabout. So I mean, just going by their speeches, for example, I can't think, thinking back to the past couple of months speeches, certainly there's not much mention of the dollar per se. If you look at a country like Japan, for example, where the yen has, I mean, really gone through some historic moves. It crossed 150 just a couple of weeks ago,
There you go.
and even there, it's been very indirect how much that's fed into inflation. That's almost what, a 50% increase, or it should be a 50% increase in import prices for anything that is being imported, which is that's almost all of Japanese energy. It's most of what Japan
Everything.
eats is also imported. Yeah,
Everything.
Japan, yeah, import a huge amount of stuff, and all of that would have gotten like a 50% price hike, and yet when you actually look at Japanese inflation, is very minimal. So I think that the Fed is not really seeing devaluation or the dollar value as a real strong mechanism
Okay.
for inflation. I think that they're a lot more interested in interest
Preserving,
rates.
yeah, preserving the bond market, right?
Yeah, that's what it is. And I mean, what I wish they would do is instead take some of that sort of prestige they have and aim that at the federal government and try to get them off this path they're going on straight off a cliff, but I think there's very little backbone for that in the Fed. And I think the thing to keep in mind here is that Jerome Powell, for all his flaws, okay, for all of the sort of pale imitation of a Paul Volcker that he's turned out to be, he's also the best we got on offer. You look at when he was up for reappointment under Biden, the other people in the running, Brainerd, there were a couple of people in there who would just, dyed in the wool MMT inflationists. Powell's really as good as it gets. So, in terms of the long-term trajectory for the dollar, I feel like we know how the book ends. We don't know how each chapter ends. And, the book on the dollar is that every force in Washington, I think, is arrayed to ultimately weaken the dollar. We can look at the long-term chart of the dollar in terms of purchasing power.
Do you believe this, Peter, that if you get the direction of the dollar right, you get everything right? That it has really been for a long time all one market. When the dollar is weak, risk on happens, metals rally. Bitcoin, I don't know what it's correlated to, but for the most part, if you get the dollar right, you want to be long the world if it's going down.
You want to be long all assets in the United States?
Long everything, long the world during a bear market in the dollar. During a bull market, it's a headwind. A bull market in the dollar is a headwind for assets. So
I haven't,
do you agree with that?
There's logic to it. I haven't gone back and sort of statistically back tested. I think that the noise in that kind of a correlation could be that there are a lot of other factors driving the dollar that include what other countries are doing, right? So one thing underpinning the dollar has been low rates in Japan, for example. So that's, separate. That's
well, a lot
like
of people say U.S. exceptionalism, which they're saying U.S. the cleanest dirty shirt on the globe. So that's what a lot of people say is what's held up the dollar.
To a large degree, that's been true. Although, I will say over the past 30 years, at least, the Bank of Japan has been, they've engaged in less money creation, but they've had, of course, lower rates than the U.S. But yeah, in terms of, however bad the Fed is, the European Union has been probably about as bad. It's tricky. I think at the moment, they're a little bit more conservative than the Fed, but they have a lot of sort of political pressures on them. So, for example, if we look back at the 2009 European debt crisis, you've got a lot of mouths to feed over in Europe politically. And so we can imagine if a country like Italy, there are a lot of basket case economies in Europe that are run very poorly. And if some of those countries need help, then the euro is ultimately going to be sacrificed for them. And so I think that there are kind of larger risks. If you compare what Italy does to Europe in terms of financial risk versus, say, a bankruptcy of Illinois or California or something, I think the risk is a lot greater over there.
Why do you think Xi came to San Francisco?
His economy is doing pretty badly, which is kind of a strange spot for China to be in.
So here a picture speaks 1,000 words. So could it be this?
Oh, for sure. They've had, I think they've had about 15 lost years. When you look at the stock market, if that one can go back to 2006 or 8, if you go all the way back, it is nuts. They've just gone absolutely nowhere. For all of how people get excited about the future is China. Stocks anyway they've looked like Japan. They've just been moribund. And for a long time, China has had really so for a long time, China has had really good GDP growth. Now, a lot of that was kind of fake. It was basically easy money pumped out by the government. A lot of it was overbuilding. You've seen online these ghost cities. Could they take us down,
Peter? Because they used to say when the U.S. caught a cold, the world got pneumonia. But I remember in the great financial crisis, Great Recession, was it great for you? It wasn't that great for me.
It wasn't as great as the Depression, I will say that.
Okay, so back then, China was a growth engine. And a lot of people give their growth credit for pulling us out of what was happening here. in 08, 09. So if it could be that way, and they're going through some type of deflationary impulse right
Right.
now with their real estate issues, could they take us down with them?
Yeah, so you want to kind of disaggregate, like if you're looking at it from a global level, like if you're summing up all of the GDPs in the world,
Yeah,
then there are probably a lot of periods where China is holding things up. In other words, China is keeping things above the zero line. But when you sort of dig down and you ask, okay, what is the actual real world impact of China on us? The main mechanisms that a Chinese collapse would hurt us is number one, financial. So there's a fair amount of U.S. Investment that's over there. A lot of that is with institutions or some of it bleeds down to mortgages and such, but a lot of that is kind of people who can take care of themselves. And, if they lose a lot of money, so be it. They'll have to sell one of their two yachts. The other mechanism is manufacturing, right? So China has largely become the world's factory. It's done that through means fair and foul. But at any rate, that's where it is today. And so I think that the main mechanism at the moment, the way that China is going to impact the U.S. economy, is that they are flooding out cheap exports at this point. So the government has doubled down on giving cheap capital to factories. They're slashing prices in industries like electric vehicles.
yeah,
We're going to
that's
get
the war.
absolutely slaughtered for sure. And so that's
Yeah,
kind of a two-edged sword. So on the one hand, it can be pretty good for consumers. So that could lower household inflation, especially for stuff that one buys from China, so clothes and toasters and whatnot. But on the other hand, it's also, it's going to be a body blow to what remains of American manufacturing, especially for these kind of crony government projects. They're putting a lot of money into things like semiconductors and green tech. I think those are just absolutely going to be wiped out. They're going to end up like 1,000 little Solyndras, all
oh
costing
yeah,
taxpayer bailouts.
okay. Um, I want to touch on WeWorks, which you're writing about.
Yep.
It was the strangest company from the CEO down, and happened during, before the tightening regime, where
Yeah.
people were buying, they're buying SPACs and everything.
Yep.
Everything went up, meme stocks, everything. You said there's a hangover and there's some fallout to come from this company as they go through bankruptcy. And already kind of a weak sector under duress in
Yep.
commercial property market, right?
Yeah, for sure. WeWork is a really strange company. For a long time in Silicon Valley, the running joke was that, like, if you're a venture capitalist, you're going to get all these pitches where people are going to be like, okay, we're going to combine dog food with Uber. All right, we're going to, we're going to combine. It's like a snow cone joint, but Uber. Okay. And so in this case, what this guy did was basically it was like offices with Uber. And the fundamental business model has been it's been around for 100 years, which is where you take a store that's lost its lease and you have like an empty building for 3 months while they find a new tenant. And then you show up with like a dollar store, and you basically just like bottom feeding real estate that happens to be empty. That was kind of the impetus of the shtick, So yeah, we're going to throw a bunch of desks in there and then we're going to rent this space out. And, they caught the whole Uber wave and got the VCs excited. And so this thing, at one point, it was worth $47 billion. And, now, I don't know, it's worth 90 million and change. So it's basically wiped out. But what's interesting about it is that somewhere along the way,
Really, Peter, I wouldn't mind being wiped out with 90 million.
yeah.
Ever think about that?
Well, how do you make a small fortune in
Oh,
off-brand leases?
yeah,
You
right.
start with it.
Yeah.
So, but yeah, and part of the problem here is that they got real big, and then when they wiped out, they got this huge footprint now that's getting wiped out. So that's something like 590 commercial leases and generally large buildings in cities all across the U.S. There's a lot of them in there international as well. Those are all now wiping out. They've already canceled several hundred. They got more to come, or I think they canceled 69 or something, and then they got another 400 or something that they're revising. And that's the problem because we've already got a lot of drama, a lot of pain happening in commercial real estate. So you've had buildings. Let's see, there was just a building in DC, pretty prime building, just south of DuPont Circle. So
They're
it's really
handing
good.
over the keys.
70, yeah. Well, and the building south of DuPont got a 77% haircut. You've had, major bankruptcies in San Francisco. And I think what happened there, part of it is just kind of the standard boom bust, right? So when the Fed makes
Right.
money real cheap and then they jack up the rates,
Yeah.
then that's going to whipsaw commercial real estate. But then you're kind of piling on. You've got the work from home thing that really expanded after COVID. That's now made a lot of offices obsolete. And then, of course, you've got the just post-apocalyptic mismanagement of American cities. I mean, they make the 1970s look well managed. The whole escape from New York 70s.
Yeah.
At some point, people are going to look back at that nostalgically. And so there's just a lot of companies don't want to be in these major cities. And of course, cities like New York, San Francisco, because of the previous valuations, those are a huge chunk in terms of dollars of commercial real estate loans. Those loans make up something like 30% of regional bank loan books. Okay. And so if those go down wholesale, then it could potentially knock more banks out. Then you get this chain reaction where a regional bank might have to sell down its treasury stack. Everybody in the world is currently selling treasuries, including the Fed. The Fed is winding down its holdings by something like 95 billion a month, which is a pretty substantial amount. They're down, I want to say 1.1 trillion, 1.2 trillion so far in treasuries that they've rolled off. So if the Chinese are selling, the Saudis are selling, the Japanese are selling, and you've got the Fed, the giantest elephant in the room, selling. Now, if on top of that you've got regional banks selling out to cover their commercial real estate losses, then the question is who the heck is buying? Because Washington has a tsunami of debt coming out, right? Something like 8 trillion that they've got to refinance this year. They got another new 2 trillion in fresh debt on top of that. So that's 10 trillion that needs buyers. And for perspective, the entire US banking system has just over 20 trillion. So where is all of that demand going to come from?
Yeah. Do you think that we still have an ongoing banking crisis, that SVB was not the end of it? And do you think that this is engineered so that, say, for example, we get that bear market in the dollar, people become less trustworthy of banks. They're worried about where they keep their money, that the CBDC will be offered as a fix?
For sure. Let's see. So, I'm sorry, remind me what the first question was there?
That could this have possibly, do we still have an ongoing banking crisis?
Okay,
And
right.
it really wasn't the end of it. They close them on the weekends so people don't notice.
Right.
And could it have been engineered since the Fed knew what these banks had on the books so that people are not confident in the banking system, and that they'll have a fix with the central bank digital currency, which doesn't come from the Treasury. It makes the Fed the bank.
Yeah. Yeah, I think that without a doubt, the banking crisis, it's not that it healed or that it went away. It's that they pre-bailed it out. So the lesson that they got from 2008, when the banks started crashing in 2008, the gamblers had, lost money, and they came to us all for a bailout. And talking to people who were in Washington at that time, I mean, it was a full court press. They were talking about there's going to be babies being eaten in the street. I mean, they put so much pressure on these guys. And the lesson that they took away from that is that next time we're going to have the thing be automatic. Okay. So, now it's like you don't have to call up your senator and threaten them to get a bailout. No. It's all taken care of. It's like going back to your hotel room at night. You got a mint on the pillow. Here's your bailout. Don't worry about it. It's all covered. I think that's where we really got today. And that was built in the wake of 2008. So you've got the BTFP. You've got the, lending against fictitious asset values. I mean, it's just an absolute scandal. When you've even got the FDIC expansion, so it covers millionaires now. So, I mean, none of that was fought for in this round. Okay. All that, I mean, they just showed up, the mint on the pillow. So yeah, I think that we absolutely do. We have a continuing crisis, but the Washington is kind of rigged.
It'll be invisible. It'll be invisible to us.
Yes, right. It'll be invisible to us. Nobody goes down until everybody goes down. until you get to the point where it's too big to bail out. And
Okay,
I think that's
so
really what they're building. So then,
yeah,
right.
yeah,
Yep.
so in this type of economic environment, I know a lot of people listen to you. You have followers. What are you advising them to do? I know that you're a proponent of Bitcoin. Is that correct?
Yeah, I like Bitcoin. I like hard assets. If we are in the
Bitcoin and gold?
1970s,
Yeah.
I'm a huge fan of gold as well.
Okay.
Bitcoin and gold, in terms of how they behave, Bitcoin is built to imitate gold. Fundamentally, it's a digital form of gold. The guy who built Bitcoin, I mean, you can tell from all his writings, the pseudonymous Satoshi Nakamoto, huge fan of gold, huge fan of Austrian economics, which in turn is a big fan of gold. It was built to operate like gold, and so far it has. It's been like super gold. When gold goes up, Bitcoin tends to go up a bunch. When gold goes down, Bitcoin tends to go down a lot. Now, Bitcoin has a lot of noise. It's a new thing. Most people are still not familiar with it,
So
so it's going to fluctuate all over.
that's a tighter correlation than people were comparing it to risk on with NASDAQ. You've been watching
Yeah.
gold be a tighter correlation market to Bitcoin than anything else.
Well, yeah, it's funny. Like Bitcoin is sort of, if like gold and a .com had a baby, it would be Bitcoin, right? So you've got certain elements of it which are deep value. You have a fixed supply. Gold is actually surprisingly flexible. Generally about 1.5% or so is mined every year, but that is flexible to the price. So if gold goes up in price, then you get more mining. Bitcoin, on the other hand, is fixed. It's absolutely fixed in the number of Bitcoin that come out. But then at the same time, because it's a growth asset, because the people who are into it tend to be younger, they tend to be a little bit more footloose with the money, and so it's got this huge growth element to it as well. So it's interesting. It's certainly not where you would park the kids' college fund.
Okay.
It could go to $1 million. It could go down a lot. Who knows where it's going to go? But I think sort of
It's
zooming
tough
out
to
on it,
value. It's tough to value, isn't it?
it's very tough to but I mean, so is gold. I've done back of envelope calculations. The standard argument on gold is that it represents industrial demand and jewelry demand. Thing is, if you sum up shadow markets, like if you look at silver demand and you look at industrial demand for other comparable metals, when you sum those up, by my estimate anyway, roughly 1% to 2% of gold's price is made up by its physical uses. The other 98% is speculation that gold is going to eventually replace the dollar. Gold and Bitcoin are essentially the same asset. They are speculative plays on the prospect that the dollar is going to fail and that we're going to need some kind of hard money to replace it. What excites me about gold is that you've got living memory of it, right? We had a gold standard, at
Yes.
least on a fundamental level, until Nixon broke. And that was only 52 years ago. There are people who
Remember
actually
it.
had careers on Wall Street. Yeah, exactly.
Yeah.
Under
Yeah.
a gold standard. And then, that's, I think, kind of psychologically easier for people to understand going back to the gold standard. On the other hand, what excites me about Bitcoin is that, if we look historically, if you're a gold bug and you're arguing with somebody who likes paper money, and a logical thing for them to say might be, well, if gold is so amazing, how come no country uses it, right? You got 200 countries in the world, nobody uses gold. Why is that? And I think the answer to that is because government sees gold, right? If you're trying to put out a currency and it's gold backed and you tell everybody, I got the gold, trust me, it's hidden. Okay, that's not going to work. You got to show them the gold. You got to put it in a built like a vault with walls and guards and the whole deal. You are going to, at some point in that process, the government is going to discover where your gold is. And at that point, they're going to come over and have a chit chat about what they'd like you to do with that gold. It's a fundamental vulnerability of gold. It's ironic because the very reason why people like gold, which is its physical backing, is also the exact reason why it is eternally vulnerable to governments. And so that's why we have this cycle where the governments get a hold of the gold, they create inflation, they crash everything, people go back to gold, government kind of, drives, straight for a little while because the cop's in the rearview mirror, everybody's watching them. And as soon as the cop peels off the highway, boom, he's off again. So we have these boom bust cycles over and over again. What I like about Bitcoin is that, for me anyway, the most exciting thing on Bitcoin is that it cannot be seized. It does not have physical instantiation. You cannot go and visit, the Fort Knox and seize the gold. And by the way, I mean, many hackers have tried to bust Bitcoin. You would make a ton of money if you managed to bust Bitcoin. Many have tried. It's like a sewer rat. You can't kill it.
So
Governments
even when
can't kill it.
countries make it illegal, like
Yeah,
China did,
right.
people still have
Yeah,
Bitcoin in China.
that's what's amazing. Yeah, right. People keep using it.
Okay.
And they keep using it in China. Now, you don't use it for day-to-day purchases like buying a coffee, but Bitcoin's not really good for that anyway. You've got high transaction fees on it.
Right.
So, like, that's the kind of thing the governments can choke off because the coffee shop's not going to accept it, right?
Right.
The government knows how to visit the coffee shop. So, right, but the parts that the government cannot touch are the savings rail. Okay, so, Chinese might still hold Bitcoin as a store of value, way to protect their life savings. That savings demand in a currency is the vast majority of why people hold that currency, and you see that in gold as well. Like, how many people are holding gold so they can buy a coffee? Zero, right? All of it is long-term savings type demand.
Right. Why don't we wrap it with this, Peter? I don't think Rod Serling could have written an episode of what we're facing
It really
politically
is.
in
Yeah,
America
yeah,
next year.
yeah.
Are you worried about it? I mean, there are some people, a guy named Martin Armstrong, who says there won't even be an election.
It's tricky. I think our only hope is that the frog jumps, and the water has been getting hotter our whole lives, and I think that we've been surprised how the people don't jump or the frogs don't jump. If you look at San Francisco, for example, you see how bad things are there, and somehow people do not put it together, right? They don't vote these bozos out. And so part of me thinks that if we get some sort of an acceleration, then finally people wake up, they shake out of it. And, I think the last time we got that was the 1970s. So, people in the 60s, I mean, it's almost cute to look how sort of naive Americans were about the government, about, whether they were telling the truth. And then you fast forward, like if you went into a coma in 1962 and you woke up at 1971, you'd be like, these are different humans. What happened? People just lost all faith in the official institutions. And we are seeing that now.
Oh, yes.
If you look at faith in universities, in, any kind
Everything.
of organization,
anything centralized.
That's exactly it. Anything that's been infected by the left, I mean, they take it and gut it. And so part of me, you hate a crisis because it causes victims. And, I would much prefer, like, part of the reason why I try to highlight some of these things is that I want the frog to recognize the water is boiling before it boils. Okay. I don't want him to jump because he already got singed, because it's kind of 50-50 at that point. I want him to understand what's happening. But do you tell people to avoid
equities like indexes and the magnificent? What do you think of? We'll wrap it with this.
Yeah.
Is the Magnificent Seven really magnificent?
Yeah, well, they've made up, God, I think it's Jim Bianco who keeps track of this, and they've made up somewhere between 95 and 105% of all stock market gains. I mean, basically, the stock market is the Magnificent Seven. Everybody else
like
is sucking
the Nifty
wind.
50.
Yeah, that's exactly what it is. And, I'd be cautious because whether it's the Nifty 50, the Magnificent Seven, if you go back through history, those kinds of concentrations tend to happen before a crash. They tend to come out of periods of easy money. I think sort of zooming out in terms of what to recommend people as an investor, most of the time equities beat just about everything. They don't beat Bitcoin in the past 13 years. But anyway, generally speaking, equities do really great, right? If you go back, 100 years, you're looking at maybe 6, 7, 8% real returns. I think your default should always be equities, all right? Unless there's a very strong argument against it. This would set me apart from, say, a Peter Schiff, who I think has been wrong. We'll just leave it there. But right, so I think broadly speaking, your default should be equities. At the moment, I don't hold any equities at the moment. I have a speculative piece in NVIDIA just for giggles. But I don't hold any. And the reason is because I think if you look at where the Fed is, where inflation is, where rates are, and where GDP is, I'm concerned that we are coming into a crash. The Fed has never dismounted elegantly from an inflation this high in 110 years. They've always crashed the economy. This time could always be different. Who knows? It could be something that none of us are thinking of, or that I stupidly am the only one who misses. That's entirely possible. But I think right now the balance of evidence says that you'd be picking up dimes in front of steamrollers. Having said, yes, I agree. Like 90% of the time, you should be full in equities, even growth equities. I mean, most of the time, what I think is large.
Okay. It's interesting. So
Yeah.
growth, you would be talking about like the Russell, which has really underperformed until a few weeks ago. IWM.
Yeah, the Russell, but not necessarily only small cap. I mean, large cap, also tends to do well. Large value, actually, I think beats the socks off small value. But yeah, I mean, for me personally, I'm sort of at the stage of waiting for the shoe to drop, and then at that point, as you mentioned at the top, you were alluding to the sort of blood in the streets moment when there's huge amounts to be made on equities. I think we're absolutely going to get there. And, if you had jumped in the market in, say, March of 2009, I mean, you made out like a bandit. So you always, I think, want to be aware that,
or April of 2020. That was even better.
Oh my God.
The COVID low.
That was frustrating. I wanted to like max out my credit cards. I wanted to borrow money from like people down the street. It was so obvious that you were going to make a ton of money in early 2020. It was just frustrating. But anyway, yeah, absolutely. You want to buy in when there's blood in the streets always.
Well, you know what? There were pearls of wisdom during this talk with you, Peter, and also I had a great time listening.
Great. Yeah, thank you, Dale.
And learning from you. You want people to follow you and go to your podcasts, and what would be the best way? Do you have a service besides your podcast? Do you put together a letter that people subscribe to?
I do. Yeah, check out peterstange.com. I've got a weekly podcast, a weekly newsletter, and then I'm also really active over on Twitter as at Prof. Stange. It's pretty much where everybody is. I'd like to thank Elon if he's listening. Thank you for what you've done. So the conversation is alive and well over there.
Okay, so there you go. There's Peter's website. Subscribe here to his Substack newsletter, and include him in your intelligence gathering. A guy who remembers from what he was taught how economies might be run again someday.
Someday. We will get there.
We should never lose hope, right?
I am extremely optimistic, because once people wake up, they don't go back. So no, we are winning. It's depressing. It's not going to be fun between here and there, but I am very optimistic we're going to come out just fine on the other end.
I say that hope is the oxygen in our life and the carbon dioxide in our trading.
Nice, beautiful, love it.
Nice meeting you, Peter, really, and much success. I look forward to talking to you down the line.
Yeah, I'd love to, Dale. Appreciate it.
All right. Peter St. Ange, nice to meet you. Hope everyone enjoyed it. Good hunting. And remember, don't just count your pips, count your blessings. Adios, Peter. You're now my trading warrior brother.
All right. Thank you, Dale. Adios.